as an owner-occupant. My name is Matthew Donato. I'm one of our senior consultants and keynote speakers here at Cirrus Consulting Group. So first and foremost, I wanted to give everyone a little bit of information about Cirrus, who we are, what we do, and why can we put on this evening's webinar. So we are a healthcare and dental specialized tenant representation firm. We're actually founded by dentists for dentists over 26 years ago now. And this was really because we noticed that many of yourselves and your colleagues were being taken advantage of by some of the landlords and what was happening. And then beyond that, also helping to efficiently structure a lease agreement for those that are looking to own and occupy their own building, and really emphasizing the importance of that lease agreement. Now, to the date, we have over 12,000 dental and medical office leases negotiated. And beyond that, we've actually helped negotiate, structure, and review over 25,000 healthcare specific lease agreements. Now, really what makes us unique here at Cirrus is that everything for us is done in-house. We have our in-house legal, leasing, and consulting departments. So our legal team focuses on structuring those lease agreements for you this evening, working with you on ensuring that the components of the lease are properly structured to best suit yourselves, your practice goals, your ultimate transition goals, so on and so forth. Our leasing team makes sure and takes a deep dive into the actual specific market, all the components of your specific market, making sure that your rental rate is properly structured to be in line with market and to your goals as well. And then, of course, we have our consulting team, which, as mentioned, I am part of, and I really focus on working with yourselves, developing the proper strategy for structuring your lease agreement, as well as coming up with the right ideas and educating you on the intricacies of the lease. Now, annually, we represent and assist over 500 doctors throughout North America. And we deliver over 100 continuing education accredited seminars and webinars annually, just like we are on here this evening. And we also lecture at most of the major dental conventions, such as the Hinman Dental Conference, the Greater New York Dental Meeting, Pacific Dental Conference, and Yankee Dental. Now really, as well as the California Dental Association. Now really what makes us unique is that we work with dentists nationwide, right? Everywhere from Anchorage to Honolulu, all the way up to Key West and on the East Coast as well. Right, so we really have knowledge all across the country and are able to take a deep look at each and every unique situation. Now, what is the purpose of this evening's webinar? Well, first and foremost, we're going to discuss how to create a balanced and customized approach to the actual lease creation itself. Right? Then we're also going to go through the importance of the healthcare lease agreement. Why is this necessary for you? Why is this different than any other lease agreement that there is? As well as discussing what are the best rental rates to suit you, right? I know many of you on this evening's call are discussing, there may be an arbitrary amount that you're paying yourself, and it's not exactly the best one for you. We're going to go through each and every, the intricacies here this evening on which rental rate and what type of rental structure works best for yourself, for your personality, and your career goals. Then we're also going to discuss the key terms and conditions within the healthcare office lease, what impacts they have, and how they can be better structured or best structured for yourself, not only as the current owner-occupant, but also for yourself when you ultimately become the landlord. Now, why is the office lease so important as an owner-occupant? Well, first and foremost, it's to mitigate risk and exposure. Now, what do I mean by that? What I mean is that we want to ensure that you are protected, not only yourself, but your estate, your family, and your practice, ensuring all are separate, ensuring that it is properly structured to gain the most security and alleviate the most liability. This goes hand in hand with separation of entities. Now, most of you on this evening's call should have two separate entities. One corporation that owns the building and the property, as well as another corporation that owns and operates the dental practice. Right. Now, we also want to discuss the proper rental rates to avoid taxation issues. Now, what some of you may not know, and I'll get into this a little bit, and get into this further a little bit later on, but if your rental rates are improperly structured, or if you're maybe paying yourself too much or too little, the IRS can have a major issue with this. And I'll go through why and what exactly needs to be done to ensure that you're not facing any major taxation issues down the line. And though many don't think of it, the office lease is essential to actually selling the practice. Right? Most new doctors, dentists, associates, so forth, if they're coming in and buying a practice, most will not have the financial appetite to acquire both the practice and the property. So we want to discuss the intricacies of the lease and how that really boils down and what that helps you do in terms of selling your practice. And I would guess for many of you on this evening's call that increasing the value of your property is one of the top priorities. And we're going to discuss today why the lease is an essential part of that as well. So now we're going to get into some of the key factors of your lease agreement. Now, how I want everyone to think of the lease really boils down to this graphic here. Right? So as we can see on both sides of this spectrum, we have completely landlord-friendly and completely tenant-friendly. Now, it's not to say that one is bad and one is worse and that they're better or worse than each other. But really what we want to show here is that we want to work to as close as mutually beneficial as possible. Now, given that this is a scale, as we can see with the arrow here, this moves, right? Depending on the risks, depending on your transition timeline, depending on practice values, this can move in a direction that you are more comfortable with. Now, when you are the owner-occupant, obviously there's a lot more leniency for yourself on the terms and conditions of the lease. But what happens with you when you sell your practice and you become the landlord full-time, right? That's when we want to move this arrow to work towards ensuring a strong tenancy for yourself and ensuring reoccurring revenue from your tenant, right? So we want to make sure that we're somewhere in between totally tenant-friendly, totally landlord-friendly, because if your lease agreement is completely landlord-friendly, many tenants, many buyers are going to be scared off by the lease agreement, as that is a big part of their practice valuation, right? And adversely, if it's completely tenant-friendly, now you as the landlord have relinquished a lot of control to your tenant and are giving yourself much less of a say in and control in how to manage your space and do the things that you want to do with it. Now back to my point on mitigating risk and exposure in the lease agreement. Right, going back to that separation of entities that I mentioned earlier, right? Separating the practice and the property, having those two corporations that ensure that one can be affected without the other and vice versa. Now, one of the main reasons that this is very important is from a lawsuit perspective. What if somebody slips and falls on your property and they hit their head, right? If you do not have a separate entity that owns the building and owns the property, this gives that individual the right to come after property and the practice. So essentially leaving yourself open-endedly exposed in the event there is an accident on the property. Right now, obviously that's a very extreme example, but I can say through my experience in doing this for a number of years, I have seen this happen time and time again, where there is something that does occur on the property, and if they didn't have their corporations properly structured or a lease agreement separating the entities properly, both corporations or the one corporation that was all encompassing took a large hit because of something that could be mitigated and reduced so simply. Now, the other point in terms of separating the practice and the property is from the protection of your estate and protection of your family, right? Now, in the event that anything is to happen to you, doctors that are on this call this evening, whether it be a physical injury, any form of mental incapacitation to the point where you're no longer able to practice dentistry, or worst case scenario, you are to pass away, what happens to the property? What happens to the practice? Right? Are you just going to have that empty shell sitting on a piece of land with no business coming in? Obviously, that's not the case that you want, right? So by having that lease agreement in place, what you're ensuring here is that your family still retains an asset and has the ability to sell a practice that has been successful and continue on with cash flow. And if you are in a disability format, obviously you have the ability to capture reoccurring revenue as well. But it's very, very difficult to do this without a lease agreement in place unless you're looking to just sell the building in its entirety. And that goes onwards to discuss protection of one of the most valuable assets. And now I say most valuable assets here because we're talking about both the practice, the investment that you've made into your practice, your lifeblood, if you will, as well as the building that you have paid for, kept running, and are invested in for your practice. So without having that lease, you don't have that protection for the building, you don't have that protection for the practice, and you're leaving yourself very open-endedly exposed. Next, we're going to be discussing how to properly structure your rents. Right now, what you want here are rental rates in line with the market. Now, you may be thinking to yourself right now, why is that important? Well, it's important for a number of reasons. One of which being in terms of possibly selling your practice. Right? If you're looking to sell the practice and your rental rates are obscenely high because you had formatted it as such for some reason, it's going to scare off potential buyers. If it's not in line with market, it's going to make your practice less attractive to acquire. Right? That is if you are planning to stay as the landlord and only sell the practice. Now, it's also an issue in terms of taxation, right? And now what I mean by that is that if, let's say, for example, you're paying yourself above market, right? If that is the case and it's significantly above market, sticking with the example here, what that does is it actually allows your practice to claim higher expenses and therefore shows that you earned less income in, let's say, 2020, and therefore you are taxed at a lower increment. However, you're also paying yourself that money and recapturing it. The IRS does not like to deal with situations such as this, and this raises red flags for them. They see that you're actually paying yourself back and forth, right? The money is moving from one pocket to another, and you're doing so in a way to get a discount on taxation. That causes some big issues for the IRS, unfortunately. So what we want to do here is ensure that we're keeping those rental rates in line with the market. That way, not only is your property and your practice still attractive, but it also shows that you have a history of paying off those rents. Now, with that thought in mind, some of the most common errors I see when structuring rental rates is, number one, just setting arbitrary amounts. Fortunately, I can't tell you how many times through my conversations with yourself and your colleagues that I've heard, I'm paying myself X amount per month. And when I ask why, they said, well, it seemed like a good idea at the time. That's what I thought it was. Right? When you're just giving yourself arbitrary amounts to pay and not looking at what the market rates are, it opens yourself up to issues that we mentioned before, right? Such as those taxation issues, those practice valuation issues, so on and so forth. Now, another common strategy that I hear is that the rent is structured to pay off the mortgage. Right? Now, that's all well and good. Obviously, we want to pay off that mortgage as fast as you can. However, the best way to do that is not by doing it with the rental rates per se, especially if it's, going back to what we said before, bringing you too far outside of those market rental rates. Or if it's on the low side and it's causing you to pay less than market. Right? We want to ensure that there's a steady cash flow from each corporation. We want to make sure that it fits in with your costs and fee scheduling. And we also want to ensure that it's not too high, causing a burden, causing taxation issues, and so on and so forth. Now, with rental rates in mind, what I want to discuss with you all today is the different types of rent. Right? What are the best types of leases for you? And now there are three main types. First and foremost being the gross lease. Now, this is the most simplistic form of a lease for yourself. Right? All this ensures that you pay yourself a set amount every month, and it covers whatever cost you have deemed you believe is going to happen throughout the year. There's no fluctuation in this. May you have an increase year over year, possibly, but realistically, the gross lease is, let's say I'm paying myself $7,000 a month. I continue to pay myself $7,000 a month forever and ever. Right? And now that would also be the same. Let's say, once again, you sold your practice, you've now become the landlord, and you have a dental tenant in your space that's taken over your practice. If they have taken over under a gross lease, you will only be receiving that amount every month. Right? Now, obviously, there's pros and cons to this. A major pro being that what you're doing here is there's no real calculations. Right? If you have additional expenditure on the building, such as any repairs, the roof needs to be redone, there's plumbing issues, so on and so forth, you're getting this monthly set amount from your tenant, and you always know it's coming. Now, that just makes things easier for you. There's less calculations, there's less additional things to think about through this process. Now, some of the negatives in terms of the gross lease are that if you need to do a major repair to your building, to the practice, to the office, you could be then using money out of pocket. Right? Let's say, as I mentioned, paying myself $7,000 a month, and I need to do a repair on the building, and it's not enough to cover that. Now you're losing some money. You're paying out of pocket. And that's just one of the negatives of the gross lease. Next, we have the modified gross lease. Now, this lease and this lease form is like a hybrid model of a gross lease agreement and what I will discuss in a minute here called a triple net lease. Right? So what this does is you pay your set base amount similar to the gross lease, right? But also you're paying your proportionate share of taxes and insurance on the building, right? So what that gives to you as an owner occupant is that your company, your corp, your dental corp will always be paying their proportionate share of the taxes and the insurance, as well as the base rent. Now, what that means for you as a landlord after you've sold your dental practice is that, yes, you're giving your proportionate share. Yes, you have the lease agreement set out and you're receiving those monthly rental rates, but you're only having the insurance and the taxes covered, right? You are still leaving yourself open to some exposure. Now, beyond that, there's the triple net lease agreement. Now, this goes forward to, this is the next step beyond the modified gross. This is by far the most common type of lease across the United States for any landlord. And what it states is that you have your set base rent, whatever that price is per square foot, whatever we've worked out and is in line with market for you. But beyond that, you pay for all the taxes, maintenance, and insurance, right? Now, what this does as an owner occupant, it gives you the ability to pass on those costs from your dental corporation and your dental practice. They pay for some of the add-on costs, any repairs to the building, so on and so forth. And then as the landlord, this ensures that your tenant is paying for those additionals, right? Paying to ensure that the re-roofing is done, there's plumbing issues, the wall needs to be re-bricked, so on and so forth. This makes sure that your costs are covered, right? It leaves a lot less to chance, and therefore you are less likely to be stuck paying out of pocket for something else, right? Now, on the other side of this is that as a landlord, as an owner occupant, this type of lease agreement takes a lot more focus. There's a lot more aspects to consider when looking at this. There are a number of different calculations that need to be made, right? So it is more time consuming, but as I mentioned, this does ensure that you are getting the monetary value and you're getting what you are owed, and ensuring that there's much less being paid out of pocket by yourself personally. Now, when it comes to selling your practice, unfortunately, through my conversations, I discovered that this is a greatly overlooked portion of the lease agreement. Greatly overlooked portion of the practice and the valuation of the practice when looking to sell. Right now, there are a number of key factors that also incorporate into selling your practice. Right, and that's obviously the goodwill, the equipment, and then the lease. The way I like to describe the lease, if you're looking to sell your practice and retain ownership of your building, is like the glue that holds the rest of the practice together. Right? Want to make sure that you are retaining top value for when you actually go forward and sell your practice. So first and foremost, in terms of the lease, we want to ensure that you have sufficient term and options on your lease agreement. Right? Now, in terms of any of the major financial institutions, whether it's Bank of America, Wells Fargo, so on and so forth, when they're looking to grant a loan for the acquisition of a practice, they need at least 10 years of term on the lease in order to finance that acquisition. So when you are looking to sell, if you don't have any term or any runway on the lease, it's going to be very difficult for you to sell the practice. So I want to make sure that this process is as easy and as smooth of a transition as possible, but the term on the lease is very important. Next, we want to they will take a look at the history of your lease. Now, you may be asking yourself, why is this important? Why must they know what the history of the lease agreement looks like? Well, going back to any of those financial valuations, when the financial institutions are taking a look at the practice and taking a look at that valuation, they want to see that the practice has successfully paid off the rent and has paid the rent for a significant amount of time, right? Having a lease agreement drawn up today and to sell your practice tomorrow doesn't do great things because there's no clear proof that your practice has actually been able to pay the rental rates year over year, month over month. Now, this also gives you an advantage. Going back to what I was just saying, when you can show that there has been a successful payment of rent and that it's occurred month over month, year over year, this makes the practice attractive. They see that, look, well, Dr. Smith's practice has been paying off the rent at market year over year. We have a track record, and that is very important. And all financial institutions will be looking into that if they're granting a loan. And so will any practice evaluators. They want to see that the lease agreement has been paid. Now, going back to what I was saying earlier on when we were discussing the rental rates, right? We need to ensure that the rental rates that have been structured for the practice are in line with market. Because, as said, if they are too high, now your practice has automatically become unattractive. Right? If it's too low, now you yourself as the landlord aren't going to be making enough revenue. So by finding that happy medium, not only do you ensure that the lenders are happy because they don't want to be granting a loan for an exorbitant amount of rent, but you're also ensuring that you retain top value for the practice and ensure there is an ease of sale, right? I can't tell you how many times that I've seen the same lease agreement regurgitated over and over and over again, but not keeping up with current market terms, not having the proper language in place, and not ensuring that you retain that control. Right? Now, that's another key point of selling the practice. For those of you on this evening's webinar that are looking to sell the practice and retain that ownership, what type of control do you want to have over the practice and over the property after you sell? Right? What happens if the new buyer of your practice comes in and within 2 years they decide it's not the right fit for them and they sell? How much control do you want over that process? Right? There are a number of additional factors to consider, but for those of you on today's call that are operating as an owner-occupant, these are some of the main points for selling the practice. Want to make sure that you have sufficient term and options. Want to make sure that there's a clear, proven track record of you paying your rents and ensuring that those rental rates are properly structured for yourselves and for the incoming buyer. Right? And this goes back, as I was just saying, with the consent language. How much control do you want to retain? And what do you want to happen post-sale? Now, as mentioned earlier, I'm sure that one of the top priorities for any of you on this evening's call is to ensure that your property has top value, right? And now, what some of you may not know is that your property value is actually predicated on the lease. Right? When any valuators are coming by and they're doing a valuation on the building, if you're looking to sell the building as well, the lease agreement is an essential part of that valuation. That is because this becomes an investment property, right? You are to be receiving revenue alongside this investment, right? So by having a properly structured lease agreement in place, you ensure that you're going to be receiving more value for the building, for the property, for the location, right? And leasing history, going back to this once again, why is this important? Because not only are you able to show that you have a lease agreement for the foreseeable future, you have the ability to show that the building has been creating and receiving this much money or a certain value year over year, month over month, so on and so forth. So when you have that property value on the lease and you have that leasing history to back it up, you ensure that at the time you're selling your building, you're going to retain top value for that investment. And now going back to rental rates, they need to be fair market value. No landlord is going to come in and believe, or new landlord or new buyer is going to come in and believe that an additional tenant that isn't yourself is paying these ridiculous rental rates that are above market. That decreases some of the attractiveness for the buyers because they don't see longevity in that, right? They want to make sure that there's a consistent flow of revenue. You're not gouging the individual tenant or tenants, for any of you that are in a multi-tenant building or own a multi-tenant building. They want to make sure that there is fair and affordable rental rates. Can they be on the high side of the market? Absolutely, but not exorbitant amounts of money to be paid towards yourself. It's just not a solid investment for them because they don't see the longevity in that type of proposal. And now when we're discussing the length of the lease, right? How long should the term of the lease be? How many options to renew do you want, right? Now you as a landlord obviously want the most foreseeability, right? How much revenue can you recognize today, right? And how much revenue can the future buyer of the building recognize today, right? If let's say you have a 10-year lease in place, right, and they're paying $5,000 a month, that's $60,000 a year, right? You're looking at $600,000 plus of immediately foreseeable revenue. So by having these long-term leases in place, you have the ability to recognize revenue faster, and any incoming buyer takes that as a big plus. Now, obviously, the length of the lease, the length of the terms, the amount of options to renew, whether it's 1x5, 2x5, all of this is customizable to you, right? Going back to that graphic I showed earlier on with the dial, we want to ensure that the lease agreement is working for you, right? We want to make sure the lease agreement wraps around your life, not your life wrapping around the lease, right? And that way, we ensure that it's properly structured for yourself, but keeping that top value, that top revenue in the event that you are looking to sell your practice, or in the event that anything is to happen to you and your family or your estate is looking to sell the building and the practice. This way you're ensuring that you have your bases covered and the investment that you made in the practice and in the property in the beginning is repaid to you in the long run. Now, in terms of our conversation today, those were some of the main aspects that I wanted everyone on this evening's webinar to be aware of, right? ensuring that you have your rental rates properly structured, ensuring you have the right lease that works for you, right? Choosing between the gross lease, the modified gross lease, and the triple net lease. Which one works best for you? How much control, how much additional thought do you want to put into it when you are eventually the landlord, right? Working through all of the different components, ensuring that you're receiving top value for the property in the event that you are looking to sell, right? But those are just a small part of the big picture, right? What we're looking at here on this slide are all the different aspects of the lease agreement that are important to you, right? Such as the assignment clause. This is going back to what I was saying earlier when you're looking to sell the practice. In the event that you sell the practice and retain ownership of the building, how much control do you want to retain in the event your new buyer comes in after 2 years and tries to sell the practice again? How much control do you want over that process? How much say do you want in that process, right? Additionally, we want to discuss something like the surrender clause, right? In the event that your new tenant just decides they're going to hand the keys over to you and move out, what liabilities, what restrictions do you want to have on that? Do you want them to be able to take everything with them? Do you want them to have to leave the equipment? And really working together to find the best strategy for that section as well. You're also looking at something like improvements and alterations, right? As the landlord, how much control do you want over the physical space? Do you want to allow your new tenant or your new buyer to make any modifications, improvements, alterations, additions to the space without your consent? Or do you want to have the final say? Do you want to be the one that tells them, yes, you can do that, no, you can't, and retain that serious control over the actual space itself? Now, those are, as I said, those are just some of the various components, but we really want to ensure and have you understand that the more comprehensive that the lease is, the better. Now, the reason for that is in the event that any of these various aspects we're looking here pop up down the road, if it's not clearly delineated in the lease agreement, you've just opened up a ton of room to yourself for never mind headaches, but liabilities, right? When you have an extremely comprehensive lease agreement as an owner-occupant and eventually as the landlord, this ensures that you have the ability to move laterally and come to a solution very easily rather than scrambling to try to come to a conclusion. It's far better to go, you know what, I understand the concerns, but if you refer to section 13.4, you can see that I have the right to do X and you have the right to do Y. That way, you're ensuring that you're protected, you're mitigating those headaches, and you're ensuring that you're retaining that value. Because once again, as I said before, the valuation of the practice being predicated on the lease and the valuation of the building being predicated on the lease, the more comprehensive in each of those situations, the better it is for your bottom line, the better it is for your investments in the space. Now, an additional aspect that I did want to bring to everybody's attention is that no matter where you are, and on tonight's webinar, we have the ability to take a look at your market, take a look at the building, and gain a clear understanding on what those market rents are. Now, as I've mentioned a number of times through this evening's webinar, is that those rental rates need to be properly structured. And we have all the software on our side here to ensure that you are in line with market and ensuring that those rental rates are properly structured. As you can see here, we're tracking over 95 billion square feet. We have 4.6 million properties tracked, over 1.5 million verified listings. Right? So all of that, the same resources that you would be able to get from a local broker or so forth, we have access to all that information, and we will be able to advise and have a clear understanding on what those rental rates and comparables are in your market. Now, for all those in attendance this evening, we have a critical dates and risk analysis. Now, this is usually a $1,995 value, where we're going to spend 3 to 4 hours analyzing your lease agreement, if you have one in place today, or your real estate situation for traps, right? So in the event that you don't have a lease agreement today, we'll be evaluating the strategy on creating one, what the certain aspects are that make sense to you and your vision plan, any traps that we've uncovered with maybe the current standing you have, what that means to you, as well as what the ideal lease should look like for you. How do we need to structure it to fit your proper goals? How do we need to get there? What is the best rental rate for you? So on and so forth. And then, of course, how to create a tactical plan. Now, as a courtesy for all those on this evening's webinar, I will be waiving that $1,995 fee, and I can more than happy to schedule a complimentary personalized lease or real estate consultation with you. As you can see, my email is down below, as well as my telephone number, and please feel free to reach out. I'm looking forward to speaking with each and every one of you. But thank you for everyone attending this evening's webinar. We have a final poll here, and I look forward to speaking with you all soon. At this point, I will be answering some of the questions that I have received through the course of the webinar. All right, so I'm seeing here from Dr. Brown that he is concerned that he's looking to sell his practice in the next 6 months, but has no lease agreement. Is it too late? Now, doctor, it's not too late. I would say that we need to speak as soon as possible. It's very important that we have this structured ASAP. Ideally, obviously, this would have been done sooner, but yes, let's, doctor, please feel free to send me an email that you can see there below. Happy to discuss that with you. I have Dr. Patel saying that they are an owner, they have a dental practice in their building. They own the building as with 2 other tenants as well. Can we assist with the lease creation for them? Absolutely, we can assist and discuss that as well. I mean, there are always a number of factors to discuss there, but ensuring that those rental rates, as I said before, still there, and ensuring that you have the saleability of your practice. We'll say, Dr. Patel, if you are using the same lease agreement for the 3 tenants, yourself and the 2 others, I would say that you definitely need to, we should speak and discuss why we need to create a more dental specific lease for yourself and the pros and cons of that as well. Right, well, thank you once again, everyone, for attending this evening's webinar. I look forward to speaking with you all, and everyone have a great evening.